What's up, guys? Welcome to part 4 of our tax planning on the whiteboard series, where we're talking about the Social Security tax torpedo, and we set up this conversation explaining about how Bob took an extra $1,000 out of his IRA, and that actually cost him $407 in taxes for a 40.7% effective marginal tax rate. How did that actually happen? And what can you do to mitigate against those costs? That's what we're going to talk about today. How can we possibly avoid the Social Security tax torpedo in some circumstances? You'll understand by the end of today's video that unfortunately we can't avoid it entirely in some other circumstances. Again, quick disclaimer. This is not specific to anyone's personal circumstance. Please don't enact any strategies you hear on today's show without talking to your financial professional first. Now let's go to the whiteboard and explain how to mitigate against the Social Security tax torpedo in some instances. Okay, on the whiteboard, we are going to go back and kind of rehash a past video that we talked about in our tax planning series about the tax buckets. Now, I was actually criticized. Somebody mentioned that I actually draw like a third grader. Hey, I never claimed to be an artist. So what I did was I actually copied some actual buckets on this episode. So instead of me drawing the buckets like a third grader, we actually have those listed here. So let's take a look at this. We talked about tax diversification, and I think that is the number one way that we can possibly mitigate against the Social Security tax torpedo. So when we look at this very quickly, because you can check out the old video where we talked about the tax buckets, I like to think about how is our money taxed. If we can understand how our money is taxed, then we can actually do some tax planning for the future. So we talked about the taxed now bucket previously, and that tax now bucket is we get this nice little love letter from the financial institution called a 1099, and we get that every single year, and we are taxed on whatever grows or earnings in that bucket. So commonly we'll have things like a savings account. Now I know savings accounts are not really making that much nowadays, but they're still interest generated. We have CDs. Again, CDs are not paying a lot nowadays, but again, you will get a 1099 on any interest that you earned in a CD outside of an IRA account. We're not talking about an IRA account, right? We have brokerage accounts. So brokerage accounts would commonly hold things like stocks and bonds and REITs and a variety of different things. And you'll commonly get what's called a 1099 comp form or a 1099B form. And those forms are going to show you any dividends that were paid to you, any possible bond interest, and also any capital gains that could have been passed on to you in that bucket. So you're going to get a 1099 on these types of things. So that's called the taxed now bucket. All right. Now, we are so well trained in our society to really focus our savings on what's called the taxed later bucket. So tax later is just another word for tax deferred. And commonly here, what we're talking about is our 401k plans, our traditional 401k, our 403b. If you happen to work for nonprofits, you might have a 403b, a 457b. If you happen to work for some state governments, you may have a 457b. Not all state governments, but also there could be some other occupations where there is a 457b. And then, of course, commonly referred to as the IRA, individual retirement account. It's funny, the IRS calls it individual retirement arrangement. We're going to call it individual retirement account. So we know the money that is in this bucket is tax deferred. It's taxed later, okay? Now, we're really good in our society at saving money through our pre-tax, through our payroll, right? We're automatically having money taken out of our paycheck and going into this bucket through 401k. I highly encourage that, by the way, especially if your company is matching, right? Always do up to the match. I think that's kind of common sense. It's 100% return on your money when you put that in, as soon as that company matches that amount, plus it's going to grow based on your investments. So that's pre-tax money. So we're usually pretty good at building up this middle bucket. And it can be substantial in retirement. We talked about required minimum distribution age, right, is age 72. So current law, at age 72, we get a knock on the door by the IRS and we have to pay taxes on this money. We have to take out a minimum distribution each year, and whatever we take out of that bucket is taxable, okay? Now, the next bucket is tax-free bucket. Any qualified distributions coming out of this bucket are going to be tax-free. And really what we're going to talk about is the Roth 401k and the Roth IRA. We're not going to talk about specially designed life insurance or anything on this particular video, but that is also a possibility to have some tax-free income from life insurance. But let's just stick with Roth 401k and Roth IRA. So for qualified distributions, and what we typically usually talk about is the Roth IRA 5-year rule. So we're talking about, hey, we've met all the criteria to pull money out of the Roth IRA. We're over 59 and a half, and we've met the 5-year rule, and we can pull money out of the Roth IRA tax-free. Okay, so the money comes out tax-free, okay? And also, under current law, there is no RMDs. There's no required minimum distributions on a Roth IRA under current law because there's no taxes due. The government is basically saying no big deal. Now, when we talk about tax diversification, okay, and we're talking about how to mitigate against the Social Security tax torpedo, this strategy right here will help you. We fully believe in having all 3 tax buckets, okay? Sometimes we'll run into folks that have almost every single penny in the taxed later bucket, and they have no choice. That's how they have to live. They take money out of their traditional IRA account or 401k account, and they supplement their Social Security income because they don't have the tax now bucket or they don't have the tax-free bucket, okay? So tax diversification is going to give you options. It's going to give you choices on where to pull that money out. So if you remember, in this series, we talked about Bob. Bob wanted to go on a cross-country trip to see his grandkids. And Bob had to take money out of his IRA because he didn't have the other 2 buckets set up. So Bob had to take out $1,000 out of his traditional IRA, which caused a 40.7% effective marginal rate because it dragged Social Security income over to the taxable column on that extra $1,000. So instead of Bob being in a 22% tax bracket and it cost him $220 on that $1,000, it cost Bob $407. So if Bob had tax diversification, if he had all 3 buckets, Bob could have possibly taken the money just out of a simple savings account, right? Take $1,000 out of a savings account, and that would not have triggered any additional tax. Or if Bob had the tax-free bucket, the Roth IRA set up already, then Bob could have taken that $1,000 out of that bucket, and that would not have counted into that provisional income calculation we talked about on the last episode. So tax diversification is paramount. Now, when we hit age 72, many of us have no choice. We have a minimum distribution we have to take out of the tax later bucket. We have no choice. If we don't take it out, the IRS slaps us with a 50% penalty, 50% penalty. So we have to take it out. Oftentimes, we're going to fall into the Social Security tax torpedo situation. on that additional income because we're forced to take it out of our IRA. So one possible strategy, check out past videos, is to start consider maybe doing some Roth conversions, possibly in your 60s or really any time as possible. But prior to that age 72 could be a good decision on transferring money from a traditional taxed later account and move it over to a tax-free account. Now, what you're doing, you're voluntarily paying taxes on that money early in most circumstances. So keep that in mind. It could trigger other areas of taxable income as well. So always consult your financial professional before enacting any strategy, especially Roth conversion strategies. They can be complicated, and if you're not careful, it could trigger additional taxes that you never intended. This has been Tax Planning on the Whiteboard. I'm Jeff Montgomery. Stay tuned for future Tax Planning on the Whiteboard videos. Thank you for joining us, and I'll see you next time.